Hello, I'm Terry, and today I'll be going over valuation and more specifically over the valuation considering precedent transactions and similar companies. So, when you're choosing similar companies, it's very important to have a criteria to represent good companies to compare the company that you're evaluating. And the criteria should have revenue or EBITDA. It should be all in a certain range for all of the companies. And you should also research each company and look at their operating model, their business model, to make sure that they're operating in the same region. For example, a company could be operating in the US and you want to compare other companies that's operating in the US. So those are two that I went over: the region and the value that a company has with the revenue or EBITDA. And you also we want to look at the growth rates of revenue and EBITDA, and also the EBITDA margin. So those are things to look out for when you're comparing companies. And the reason you need similar companies for you can value your company appropriately. If you're not using good peer companies to compare your company against, your valuation will be off, and that won't be good. Just to show this, I evaluated GE here, and this is where I got my information from my peer companies. And I went to Google Finance, just typed in GE and chose General Electric. And down here, the related company section, I chose a couple of companies here to compare against GE. And also I chose a couple of companies from Yahoo Finance, and I got all the data from there. And this was just a wide range of companies to choose from. I will be doing an example of choosing the wrong companies to value a company and misvalue it, and show you the dangers of that. But to get a more specific peer group, I could have went to sector and chose industrials there, and all the companies that come up, I'm going to sort them by the revenue from the highest to the lowest, like here. And I could have chose like the first 6 or 7 companies. It goes from a range of like 42 to 148. It's rather big, so 1, 2, 3, 4, 5, 6. Probably could have chose like from 47 to 148. It's still a big range, but it's closer than what I chose the first time. And you also want to make sure that they're operating in the same country and have similar growth rates and similar margins. Okay, I'm gonna get out of here. That's a little bit by the background where I got my data from. I'm gonna go to Excel. Okay, now all the information I received from other companies were the share price, equity value, enterprise value, revenue for the last 12 months and 2 projected years, the EBITDA, the net income, revenue growth, EBITDA growth, and EBITDA margin. Okay, and I have GE's information down here for all of the same categories. Okay, and the calculation of enterprise value I showed in another video, but just a quick recap. You would need the equity value, which is the diluted share count times the recent share price. You will look up the balance sheet statement, the most recent one, and you will subtract cash and equivalents, equity investments, other non-core assets, net operating losses. You will also add the debt, preferred stocks, non-controlling interests, unfunded pension plans, capital leases, restructuring, and other legal liabilities. And that will calculate the enterprise value once you sum all of those up. Okay, so now what we need to do for each of these is calculate the max, 75th percentile, the median, the 25th percentile, and the minimum. We're going to do this for each category as I listed there: the share price, equity value, enterprise value, and so on. So it's very simple. So just gonna take the max formula here, choose all of the inputs there, and for the 75th percentile we're going to use a quartile formula. And the quartile formula is very simple. You just have to pay attention what you're doing, and you choose your inputs, and you're going to hit comma, and you're going to choose 3 or how many quarts you want to put into this calculation. Since it's 75, we put 3 because 25 times 3 is 75. And we need the median. Put a simple median formula in, include all your inputs, close parentheses, enter, and the 25th percentile. And this time we're going to put 1 because it's only 1/4 of what you need here. And here we're going to put the minimum formula. Same concept. Okay, and I'm going to just copy these formulas all the way across into all the other categories that I have listed. And there we go. I'm going to format these to clean it up a little bit. I'm just going to put all of these numbers in percentage form. Okay, I'm going to put decimals for all the rest of these here, just to have uniformity. Make sure I'm all the way over here. Okay. Having a little trouble with my keypad on my laptop. I'm gonna lose some of the decimals here. Okay. I'm almost finished with a little bit of formatting here. I apologize for the interruption. It's okay. So what we're going to do now is compare GE's numbers to the peer companies. And these first numbers really don't matter too much. What we really want to look at are the growth percentages and the EBITDA margin. So let's see. The median of the set is 9%. GE's percentage is 2%. So it's at a minimum. And you see this fluctuation of numbers, this whole range is between 24 and 2. That's really not ideal. That's why in the beginning of the video I said you want similar growth rates and margins before you can compare companies. This will not give me a clear point to evaluate this company because the peer companies that I chose. But we're going to keep going here. So we're below on revenue growth, and for the EBITDA growth we're also below. We're between the 25th percentile and the minimum. And let's look at our margins here. And the last one was actually the growth rate. Also, it was projected year 2. So now we're moving on to the EBITDA growth, and it's 3%. It's actually higher than the median. It's really close to the median. It's between the lower range, between the median and the 75th percentile. Okay. So I'm just going to highlight the background of these red, just to say it was lower. This one just a little higher. So I'm going to put green. And this just for a quick analysis. Okay, and for the EBITDA growth, just highlighting that one green also. For the EBITDA margin, we are in the minimum. We're below the 25th percentile and the median. So this is actually lower than the rest. So I'm gonna highlight this red. Okay. So when you have completed this part of the valuation, you next go down to the multiples. But before we do that, it's going to give you a background of the valuation when it concerns overvaluing or undervaluing. If the company that you are valuating have the same growth rates and margins as your peer companies, but trades at a higher or lower multiples, then your company may be over or undervalued. Let's just say, for example, if GE had the same growth rates and EBITDA margins as the peer company, but GE had lower multiples than the other company, then my company may be undervalued. So what I would do then is take an appropriate valuation multiple and apply it to GE and calculate the new enterprise value. And then from there, I can calculate the equity value and the implied share price. All of the ones I'm calculating would be implied. Okay, so let's keep going. The ones red here, they should be lower, significantly lower than the rest of these companies when I go down to the valuation. And the one I have in green, the EBITDA growth, the margin, the valuation multiple relating to that probably would say it's higher. So let's go see the case here. And for the enterprise value that I calculated up top, we will use in some of these multiples here, the enterprise value minus divided by the ER, the revenue, and the enterprise value divided by the EBITDA. So we're going to use the same formulas for all of these down here. So we just need the simple max. We're going to use the 75th percentile, the same formulas that we used earlier. We're going to be using it 3 times in this presentation. And I have to put the right amount here. I have to put the comma in the 3. Okay. Now I'm going to do a median. Now I need the 25th percentile. Need the minimum. I'm just going to copy all of these formulas over. Going to do a little formatting to clean it up a little bit. For the first couple of categories, I'm just going to put commas and lose the decimals. And for all of these, I'm going to customize it and put an X behind the numerals. I need to go back in actually. Choose custom. I wanted to display X behind the numerals. 2 decimal places is fine. Okay, perfect. Now I can compare my companies. Remember above, the ones that I highlighted red, which were the revenue growth and the EBITDA margin, they should actually be trading at lower multiples, but let's see what's the case. Okay, the one pertaining to revenue is actually trading above the median of the set here. It's actually above the max. And for the future year, it's still in the 75th percentile, and median is between that range, but it's really close to the 75th percentile. And as you remember up top, the revenue growth rate was below the median up top, and there might be a sign of GE being overvalued. And let's look at the enterprise value to EBITDA, the EBITDA multiple. This is also in the max range for the last 12 months and the future projected years, both. And for this PE ratio, we're in the negative. So that really don't really count towards too much of anything, because it's not useful. We can't compare our company trading in the negative to other companies, so it's really non-meaningful. So we'll concentrate on the other two. And it looks like that our company is really overvalued. So what we can do now is apply our peer companies' multiples to GE, and then calculate the implied equity value, and then from there calculate the implied enterprise value. No, we had the implied enterprise value here, I'm sorry. Then we'll work backwards toward the implied equity value, and then we'll find the share price. So what we'll do is choose the method. We'll get the multiple that's most appropriate to apply to GE. So probably about the 75th percentile, 10.80x. So what we'll do, we'll come up with a new implied enterprise value. We'll take that multiple, said it was 10x, and we'll multiply it by GE's EBITDA. It'd be the EBITDA here. Okay, as you can see, we predicted that GE was undervalued. Actually put that calculation in the wrong spot. No, I didn't. It's there. Yeah. So you see here the enterprise value from the basic calculation. The enterprise value for GE was 299 billion. And here it's 174 billion. So now we need to calculate the implied equity value just by summing up everything here. It's really the exact opposite calculation from going from equity to enterprise value. But here we're going from enterprise value to equity value. All of the items that I subtracted, I would be adding here. And all of the items that I added over here, I would be subtracting over here. So since I already have these numbers as a negative, the ones I want to subtract, I can just use a simple summation formula. And that's my new implied equity value. Now to get to my implied stock price or share price, all I have to do is take the implied equity value and divide it by the number of shares up top here. And see, my share price started at $29.39, but according to the valuation at the bottom, which is wrong, my implied stock price is $15.02. Okay, so that's the importance of choosing the right peer companies, because you can have a valuation that's off and it doesn't really equal that amount that you're valuing a company at. And another way that we can value a company is look at precedent transactions. And I just made some precedent transactions up because kind of hard to find. If you're not working in a bank, it's very hard to get a hold of some information like this. So let's just get started here. I have GE's number down here, and we're going to assume that all of these transactions took place. And whenever you choose in precedent transactions, you want to have M&A deals within the last 3 years or 4 years, something really close, because you want to have the same market perception in a certain range. Because if a market is really hot, it can really be trading at higher multiples than at its peer when it's not so hot. So you have to take that into consideration too. Do your research and know what's going on in the market and the recent changes. And when you choose the precedent transactions, you also use the equity value and enterprise value of the transaction, not just the company's equity value and enterprise value. It has to be the transaction. And then you use the last 12 months revenue and last 12 months EBITDA. And you have growth rates. You project the growth rates. And also you need the last 12 months revenue and the last 12 months EBITDA to calculate your valuation metrics here. And the precedent transaction should always have higher multiples than comparable companies, because when you think about it, when a company it's getting sold. It's not going to sell you exactly what it's worth. The company is going to require a premium. And as you can tell here, the EBITDA multiple is like 40.8x here compared to the maximum here, which is 21.62x. So okay, we're gonna compare these to GE. The first thing we need to do, remember I said we would use these max formulas like 3 times. This is the third and final time that we'll use all of these formulas here. So we need the max of all the companies here. Okay. It's the same concept. '75th percentile. So I need to use 3. The median of the set. Add 2 more. Add a 25th. So I just use 1 after I put the amounts in here. And here I need the minimum function. Okay, I'm just going to hit enter and copy all of these formulas over. Well, before I do that, I'm going to put it in parentheses here. I just need a little, just put commas in and deleting the decimal places here. Just going to copy all of these formulas over. And afterwards, just going to put these in percentage form. Okay. And actually didn't copy. These actually supposed to be the X's here. To the custom format. It should be at the bottom since I used it earlier. Here it is. Okay. Make sure everything else looks pretty good there. And when it comes to the precedent transactions and your company, you want to look at the growth rates. You want to see if they are similar. See the growth rate for the revenue of the first 2, which includes the first projected year, the second projected year, and the EBITDA for the next 2. The first projected year, second projected year of the growth rates. So let's check those out and compare it to GE. The first one were, I think, revenue. And the second one was EBITDA. So I'm just gonna put a little fill here. Then the second was the EBITDA. And over here, the valuation. EV to revenue. And over here, the EV to EBITDA. Okay. So GE is trading at a 2% projected growth rates. And that's pretty close to the median here. It's really the 25th percentile, but it's so close that we're gonna say it's pretty much the same. Safe to say that. And it's also trading at the same growth rate for the EBITDA. So we can say they're pretty much trading at the same growth rates. And if they're trading at the same growth rates, that means that their multiple should be similar, which is not. So in this case, we'll say, according to Precedent Transactions, it should be trading higher or being sold for higher, because these are all transactions, we're assuming. So we're going to take the median of this set and apply it to GE. And we're going to assume it's 40.40x. We're going to calculate the enterprise value, 40.4. Okay, we're going to go up like we did earlier. I'm going to hit 15.02. I'm just going to keep this to the side for comparison later. Okay, we're going to do the same thing. I said it was trading at a 40.4 multiple. We're going to multiply that multiple, which is the median of the multiples of comparable precedent transactions. We're going to multiply it by the diluted share count. And remember, I said it was undervalued, so when I applied that multiple, it actually increased from the equity value that we previously valued GE at. And when you make the adjustments, the implied equity value is 390 billion compared to 320 billion over here. So what share price would that imply? So the only thing we do now is take this amount, the implied equity value, and divide it by the diluted share count. And according to the precedent transactions listed at the bottom, GE should be valued at $38.32, and that's how much the company should pay for GE if they wanted to buy GE, because according to Precedent Transactions, that's the rate, the median rate for the EBITDA multiple that the companies really sold for. So GE should sell for a similar EBITDA multiple, which implies a $38.32 share price. And that's pretty much it for now. Thanks for watching the video, and I'll see you next time.